Hello and welcome to Big Deal. Now, the Competition Commission of India has changed the way India does deals, and the recent amendments proposed, yet to be notified, remember, are set to bring about some meaningful changes in mergers and acquisitions, as well as dominance, antitrust landscape of India and private equity VC investments. Let me welcome on the show two learned people who are going to throw more light on the amendments that are proposed and how it's going to be a game changer. Let me welcome to CNBC-TV18 Gaurav Bansal, who's a partner at AZB and Partners, and Shweta Shroff Chopra, who's a partner at Shardul Amarchand Mangaldas Company. So good to have you on the show. Now, let me begin with you, Shweta. You have been deep diving on the various aspects of CCI from its very inception. What are the notable changes that are really proposed in your view, which are going to have a huge impact on the deal scenario?
So thanks, Nisha. The Competition Act, as most people will know, has been around for a while on the statute books, and it was time for an upgrade, which is why the government has introduced the Competition Amendment Bill in Parliament. This followed a competition law review committee, which undertook the exercise of reviewing the Competition Act. As far as mergers and acquisitions are concerned, the fundamental changes to be expected in this is firstly the introduction of a deal value threshold. The deal value threshold is local nexus to India, substantial domestic operations in India.
Yes.
So given that, that's going to be a fundamental game changer, because until now, the de minimis exemption used to be, quite a safe harbor. But when this deal value thresholds will get introduced, the de minimis exemption will not be available.
So let me stop you there, Shweta, because we saw a big merger in the exhibition space very recently, where it did not meet the threshold in terms of the turnover in the erstwhile regime before the amendments really kick in at some point. And, even though there were complaints, it did not come to the CCI table. So that is one aspect. Let's delve into deeper. That is the deal value threshold of 2,000 crore rupees. Gaurav, jump in on this. How will it make a huge difference? Because 2,000 crores for now, a robust economy like India, is very small an amount for any deal. So what do you think is the thinking on the CCI's front, and what are the factors that needs to be looked at? Because the CCI chairman clearly stated in our interview that not all deals with 2,000 crores threshold will make it to the CCI table. So what are the factors that should be looked into?
No, thanks, Nisha, first of all, for having me on the show. Absolutely, you're right. I mean, the deal value itself will not be the relevant parameter. It's not the only parameter for the deal to be notified to the CCI. Yes. And that was a clarification that was very helpfully given by the chairperson himself on your show as well, which is that, look, there will be other factors as well, which will be considered to assess whether a deal is notifiable to the CCI, because let's remember the fact that the existing thresholds of asset value and turnover actually reflect the competitive position of the target, right?
Yes.
And that is the fundamental basis on which the antitrust jurisdictional thresholds are based, as opposed to a deal value threshold, which doesn't really, signify how big the target is or how big the acquirer is. So a deal value in and of itself doesn't let you know whether a transaction is sensitive from a competition law perspective. And therefore, these guidance which will be put together, again, the chairperson has very helpfully clarified that these regulations will be put in place after extensive consultation with all the stakeholders.
So in your view, Gaurav, prima facie, you have been speaking to all the industry experts. You've worked on various CCI mandates for many deals across the board. First few things that come to your mind on the factors which should be exempt.
So first of all, the factor should be related to the domestic revenue of the target, right? Like Shweta said, right now there's a target exemption. So if the asset value of the target is 350 crores or the turnover value is above 1,000 crores, it's below 1,000 crores, then you are exempt, right? What deal value will do is that even the asset value or turnover below these thresholds can get caught under the transaction value threshold.
Yes.
But there still needs to be some sense of local nexus with the jurisdiction so that CCI can exercise jurisdiction over that deal.
Yes.
And that has an effect in India, right? But the most important parameter that one needs to look at is to see that, that this turnover for the target, which is set as a threshold, should be highly disproportionate to the deal value itself, right? Because that is the fundamental reason for introducing a deal value threshold, which is to capture killer acquisitions, where you are attributing a value to a target based on its potential, competitive significance as opposed to its current competitive significance.
Okay.
So invariably, the turnover of the target in such acquisitions are going to be low.
All right. So you brought about the concept of killer acquisition. Shweta, jump in on this particular aspect, because do you think that the CCI, in widening its net on the number of deals that it comes by keeping the deal value threshold so low, is targeting big pharma, big tech, which is looking at killer acquisitions, which is a big thing overseas, being talked about, antitrust commissions all across the globe, and also in India, where some of the big firms may be looking at killer acquisitions and also trying to really cannibalize on the smaller companies with good innovation at a very nascent stage.
So Nisha, you're absolutely right. I think the intention to introduce the deal value threshold is to capture transactions which were erstwhile not notifiable because they didn't meet the asset or turnover thresholds in India. However, I think this net may be cast far too widely if the regulations and the guidance that is put out by the Commission does not keep in touch with what is reality on the market, and therefore it's important that these are defined specifically with respect to the sectors that they wish to target. As far as killer acquisitions itself are concerned, you are right, absolutely, that they are being looked at across the board. And typically what is sought to be looked at is whether that is leading to an acquisition of technology. Because in most of these digital markets or high innovation markets, acquisition of technology and innovation or R&D, those are the factors which trigger these disproportionate valuations that Gaurav was mentioning. And the idea is that the CCI should have jurisdiction over such transactions so that they may review these transactions and determine if there is actually going to be an appreciable adverse effect. But in doing so, they have to bear in mind that for the startups, the exits for both private equity as well as founders is a very important aspect. And exit to the large players, to big pharma, to big tech, is one of the ways where the founders' work product and dream is actually seen to fruition at the largest scale. So I think it's a fine balancing act. And in principle, whilst it's important to do so, but one has to do that in the context of where the Indian economy is and the impact it has on India.
So it is going to be very subjective from case-to-case basis. Both of you will, agree with that, I'm hoping, because as Shweta said, that some of the companies are designed, some of the innovations are designed to be sold to bigger companies for scalability and also for infusing more funds at a later stage. Very recently, we have seen that some of, the batteries for renewable energy storage, that kind of innovative companies have been bought over or have been invested into by the bigger companies, because those companies themselves themselves didn't have the ability to scale that company. So this is one point that I wanted to make. But Gaurav, on this particular thing, there's another aspect of private equity. Do we have clarity of private equity as well as venture capital? Because 2,000 crore rupees is going to be assessed on the basis of the full round of fundraising, or each of this private equity or VC investing into it? Do we have clarity on that?
So, Nisha, a lot of clarity will come by way of regulations, right? But there is one existing regulation which talks about interconnection, right? Which effectively says that tie down into calculation of the deal value threshold, right? First of all, there's no specific guidance on that as of now, but maybe one way that one can think about it is that, look, if the private equity players are funding a startup, having their own independent rationale,
Yes.
And without, consulting or without pulling in money with other venture capitalists or private equity funds, then such transactions should be valued independently and not cumulative. Right?
All right. So
if the private equity funds are pulling in money together, and the objective is coming out very clearly in the deal documents, which invariably it does, then in those certain cases, there is a possibility that the deal value will be considered as on a cumulative basis.
All right. So this is a very good clarity, which CCI has also given out, that private equity VC, it's not going to be on the basis of rounds if the investors are not working together and there is no interconnectivity. But on the other hand, an acquisition made by a consortium of investors pooling in together and making one decision, that will come under the radar of the deal value threshold of 2,000, because 2,000 crores is a very small amount for the kind of rounds that we have seen even in the smaller startups. One more aspect on the deal value threshold, Shweta, that we need to explain is the local nexus. What is the understanding and what are the technicalities that needs to be explored further?
So on the local nexus, I think the terms used in the draft bill is substantial domestic operations, substantial operations, business operations in India. Now, what is substantial business operations? I think the important thing to bear in mind that this test needs to be as objective as possible, because the whole fundamental aspect of notifying a transaction needs to be transparency, certainty, and consistency.
Yes.
So these three aspects the CCI needs to bear in mind in determining or giving examples of what local nexus or what substantial domestic operations in India would look like. Now, given that we believe that the focus is likely to be on tech or on pharma, I think there will be the kind of local nexus indicia will be in relation to number of users which are active, number of users which are enrolling, but it could also be more broader in terms of the research and development facilities, for example, that the parties may have, or for pharma, it could also be the trials which they are doing, or for example, the patents that they may have filed. So I think these are all very subjective, and I would just urge that in the Commission's process of defining these, A, they continue to remain dynamic and agile to remember what is the state of play in India. B, they are as specific as possible. And C, they err on the side of doing business in India, the ease of doing business in India. So I think I'll leave it at that for now. But we have to watch the space.
So each of these will require very defined guidelines. A template approach could be very good, and then with the agility on a case-to-case basis, where legal luminaries like yourself will throw more light on evolving the CCI amendments and the rules going forward as well. All right, hold on to your thoughts, Gaurav as well as Shweta. We have more to discuss on the control aspect and the material influence aspect that has been brought in by the CCI and how it's going to really be a game changer in the way India does deals. Stay tuned to Big Deal.